Hello, everyone. Welcome to Tenet's 2021 year-end webinar. My name is Kathy Hume from CHF Capital Markets. We are pleased to present to you Johnson Joseph, CEO of Tenet Fintech, who will take you through the financial results that were announced yesterday. At the conclusion of Johnson's highlights, Jean Landerville, our CFO, will review the financial statements with you. Our Q&A section will be managed by Mark Schwallenberg from MZ in Chicago. You can expect Liang Q Golden, our CEO in China, to respond to a number of the questions. We asked our shareholders to submit their questions in advance, and we thank them for doing so. We will therefore not be addressing the questions that are posted live. There is a section called Handouts located on your bottom right-hand side where you will find a reference document that you can consult during the review of the year-end results. Please note that this call is being recorded and all participants have been muted. As a disclosure statement, any discussion about future financial results and industry prospects should be considered forward-looking. Over to you, Johnson.
I'm Johnson Joseph, a CEO of Tenet, here to discuss the results of our year-end financial statements for 2021, we filed just last night. So with me today, we have Jean Landerville, who is the Chief Financial Officer of the company, who is going to give a brief presentation on some items on the P&L. And we also have, exceptionally with us today, we have Liang Q, Golden Q, who is the CEO of our Chinese operations, who's also part of the presentation here today and who will be helping us answer some questions because I'm sure you have questions related to the operations in China that perhaps he would be better placed to answer than just me. Okay, now that being said, very exciting day on the markets today. Wasn't the kind of excitement that I'm sure that everybody was looking for, but exciting nonetheless. I was told that we traded over 1 million shares today. Obviously, I would have hoped for different results, but it is what it is. You know what? For some people, perhaps today might have been an opportunity. Who knows? It's not my place to say. Okay, that being said, going into the Chinese operations, we're actually very, very pleased with what we were able to accomplish in China in 2020 and 2021. The important takeaway here is the business is growing. If you look at the revenue that we generated in China, we went from 42 million in 2020 to over 106 million for 2021. And a lot of that growth came from the supply chain for consumer goods. Now, that is very telling for us. It's very important. For those who may not be familiar with the company, when we first launched the concept in China back in 2018, we had a strategy of going after the supply chain. Obviously, China is a huge, huge market. There's over 100 million small businesses, but a lot of those small businesses are involved throughout the supply chain in China. A lot of products get made in China. So we decided we're going to start from the raw materials to factories to wholesale distributors and eventually to retailers. Now, when we started back in 2018, we did a lot of business we facilitate a lot of business, I should say, between raw material suppliers, factories, and eventually we started to make our way down to wholesale distributors. Now we are in 2021, we're really in our sweet spot in the sense where we are facilitating transactions between wholesale distributors and retailers. Now, these transactions carry better margin for us, and there are more of these types of businesses than there are raw material suppliers and manufacturers. So we really are where we want it to be. Now, what's going to be important for us over the next couple of years in China are two things: continuing to grow the consumer goods supply chain segment, which offers us better margins, right? So when we're dealing with raw materials suppliers and factories, our margins were very, very thin, and we knew that going in. But that was a means to an end for us. We knew that eventually those businesses would carry us to the wholesale distributors and the retailers. When we facilitate transactions for those types of businesses, meaning the wholesale distributors and retailers, we have margins that hover around 10%. So we went from 1%, 1 to 2% with the with the raw material suppliers. And now we are dealing more and more with businesses that are going to give us 10% margins. So eventually, when the business matures, we're talking maybe a couple of years from now, when we're talking about strictly the supply chain, you're going to see on average margins of about 10%. So that's the end goal for us with regards to the supply chain in China. Now, the other takeaway that's very important, basically, to keep in mind for 2021 is our entry into different verticals in China. So not only are we having success in the supply chain, but we've entered the insurance sector, we've entered the oil and gas sector, and we are about to enter the clean energy sector. Those are all verticals for us that will afford us margins between 20 to 50%. So very, very interesting. So all in all, if you look at the operations in China, the business grew. We had more clients related to the consumer goods supply chain. We're building our business with the insurance vertical, the oil and gas vertical, and the clean tech sector. So even though when you look at the numbers just on their own, if you look at what was forecasted, yes, we did miss our numbers. There's a reason for that. Obviously, why we missed our numbers. We were expecting the insurance sector in 2021, particularly in the fourth quarter, to generate anywhere between $11 to $15 million in revenue with margins of about 30 to 35%. So not only was the insurance going to take us over the top when it comes to the revenue of the top line number for 2021, but also the EBITDA and the profitability also. So again, there's a reason why we missed the numbers. We had to delay certain investments in the insurance sector. I think we mentioned that in the MD&A. For those of you who haven't had an opportunity to review the MD&A to understand why we did what we did, I would encourage you to read the MD&A. So I'm not going to spend too much time discussing the reasons why we were late on the insurance revenue. But if it wasn't for that, we would have made our numbers. So again, there's a lot of reasons to be optimistic about the numbers that were filed yesterday. Even if we missed our numbers, we feel very, very confident and comfortable, I should say. I was going to use another word, but I'm being careful here. The future looks bright for the company. I'll talk a little bit more near the end about what we foresee going forward for 2022 and beyond. But for now, keeping to just discussing the numbers for 2021. Again, I'm very pleased with the numbers. And now I will take it over to Jean to give you a little bit more details in terms of what these numbers were. And then we will take some questions from the audience to wrap up the session. Thank you very much. Jean, over to you now.
61 million increase or 142%. Mainly and almost 100% of that is coming from the supply chain. The rest of the smaller subsidiaries like ASFC, ASCS are quite stable between 2021. So all the revenue increase is coming from the supply chain, and it have more in proportion than last year. So the good news of that is the cost of service in percentage in total, it seems that the margin is lower, but it's not the reality. The reality is the margin is better by 4.8% versus last year for all year. And we see the increase in the third and the fourth quarter getting more close to the 10%. like Johnson mentioned, but the average for the year is 4.8% higher margin in the supply chain. I would say AGP, which is the petroleum part of it, of the supply chain that was introduced in 2021, have a very good margin. If you compare with the previous year, with last about 2% margin, now we have more than the 10% in that revenue stream. So that's a good thing. The other good thing that you don't see in the financial is that we shift from supply chain revenue from a business that we own 51%, which is ISSC, to AGP that we own at 100%, and to ASST, which is the Gold River platform, that we own also at 100%. So the minority interest is getting lower and lower, and the margin is more for Tenet than before that if we have only 51%. So that's a good trend for the company. While salary, board remuneration, and friend benefits increased by 3.7 million. Number of headcount, you can imagine with the number of subsidiaries that we have now in China, and to support the business, we increased the headcount between Canada and China by 65, which is about 45 in China, 50 in China, and a bit less than 15 in Canada between 2021 and 2020. So we have some salary increase there. There are also, with the share price getting higher, the share-based expense, which is non-cash item, increase in value, but we have to account for that. So it's $1 million in the difference. So that's for the salary. Consulting fees, there's a huge reduction between 2021 and 2020. Last year, if you remember, we have some market awareness important to have the new investment in the business in the summer of 2020. That's increased the amount that was invest in that kind of expense. But we have less than that this year, so the consulting fees lower by 3.4 million. Professional fees increase. Well, that's directly related to the audit in China, with the number of business that is coming higher, and the number of unit that we have the audit in China, and in Canada, the complexity of the business with the acquisition that we made this year, that we increased the amount of audit fees and legal fees at the same time. Public relation and press release. Well, we, as you know, we introduced into the U.S. market this year, so we have investor relationship contract that is adding some expense in 2021 versus 2020. Finance cost, this is a reduction in the expense, and is directly related to the debenture that we had in the past since 2017, and that was all paid back last year. So interest expense and accretion related to these debenture are lower by $800,000. So that's a saving on our side. Now, the investment that we made in platform like Cubeler platform and RB platform, you need to make amortization of that. So that's bringing the amortization of intangible asset higher by 1.8 million. So impairment. So the impairment on the Cubeler is coming from the shift from the previous purchase price allocation, or the evaluation that was done by third party and revised by 2 or 3 firm at the beginning, at the date of acquisition versus December 31st. So there's a shift in the revenue and EBITDA that is affecting the evaluation, the trading value of the business that we have to account it for, and that's impairment. So the impairment is $53 million in total, which is the biggest expense. It's non-cash item. It's a shift, and it's really the actual value of your revenue. So if you 1 year difference have a huge impact on your actual value when you take your discount rate. So this is the biggest expense and explained the loss of this year. The change in fair value of contingent. This is the Heartbeat acquisition. This is a little bit the reverse, is that we have contingent payable in share in 2022 and 2023. That is lower because they are just shift less by 6 months. Shift in the revenue, and this is the Heartbeat in China. So one thing, there's no impairment on that case because the evaluation was correct and we have a check, but we will pay less share in 2022 and 2023. So that's why we are like a gain. I will say my best guess on this one, I think it's going to be reversed in next year when they're going to come back to the original forecast. But for now, it's like we have revenue or less expense. But my 2 cents on this is that it's going to come back as expense in 2022 or 2023, and I'm going to be very happy because that means they bring back to the original forecast. So total expense for the year 153 million, including that 53 million, sorry, of the impairment. So it's 150 expense versus 47 million, but we have 60 million more in revenue. So if it was not the impairment, it's going to be it will look better, but we have to account for it. Income tax, so the net profit 40.5 million loss, again including a 53 million impairment versus a loss of 5.5 million last year.
Thank you, Jean. Thank you, Jean. I think now we would be ready for the Q&A portion.
Topic number one that we probably saw the most frequently asked question was just, so we basically came out in October and, raised guidance. And then a few times after that commented publicly reaffirming it, in interviews and such. And just, can you walk through like what you were seeing that, like why didn't we see the revenue shortfall and just, and felt comfortable in reaffirming that guidance at the end of the year? I think that would help alleviate some of the concerns that we're seeing.
Okay. I hope there's no timer on this thing here and people have nothing better to do, okay? Because this is not a 30-second explanation, okay, of what went on here. Let's go back to the acquisition of Cubeler, right? So we acquired Cubeler. Before we even concluded the acquisition of Cubeler, we told the market that we would come back and reassess our guidance after the acquisition was done. Now, what was happening while this was going on at the same time was the famous SEC review. And I know our lawyer is on the line right now listening to me, so I'm going to be very, very careful, okay, about what I say about this SEC review process. So we were on the NASDAQ, right, back in September, and the plan was for us. There's a reason why, okay? We went on the NASDAQ to begin with. Obviously, the prestige and having people access your stock from around the world and all that stuff. But it was also to access the capital markets. So we had been working with our investment banking partners even well before we submitted our application to the NASDAQ in anticipation that once we were on the NASDAQ, we were going to do a substantial financing with this investment banking firm and some institutional investors and really take the company to another level in terms of financing. Now, we didn't come out and say this publicly, but obviously, we were counting on raising this capital in order for us to really take the company to another level, as I mentioned before. So we had plans to close a substantial amount of capital with our partners in the US before the end of 2021. Now, when the SEC review process began and we removed our registration statement from Edgar until the review was completed, we were under the impression that the review process was going to take maybe a couple of weeks. We had no idea that we would be at this 5 months or 6 months later. I can't remember remember how long it's been now. So the thought was 2 weeks later, because we knew we qualified for NASDAQ, and our understanding was that the SEC was basically just check a couple of things, get to know our business or whatever, and then approve our listing. So, but all of these regulations were passed. There was a new process with the SEC. Make a long story short, the process took much longer than we expected. Now, what happened was we had plans, right, we had plans to commit capital both to the insurance platform that we had purchased before the end of 2021. We had plans to commit capital to that, and we had plans to commit capital to Cubeler as well, which we had acquired, right? Now, when we reaffirmed our forecast, we were still under the impression that the process was going to end imminently with the SEC. We had no reason to believe that this thing was going to take 5 to 6 months. Like, even saying it right now to me is like inconceivable that we're still at this for 5 or 6 months. But I understand why. Again, lawyers on the call, so I'm going to be careful. We had a lot to learn about the SEC's process, which we do now. The SEC had a lot to learn about our business, about the influence of Chinese regulations on our business. Make a long story short, it was a long process. But throughout the process, every time we had an exchange with the SEC, we felt that the situation was going to be resolved imminently. But again, it hasn't been resolved. So it got to a point where we said, okay, you know what? Since we have no visibility into the process with the SEC and we have no timetable, we have to reassess our plans here. So we decided against making the commitment to the Heartbeat platform because we had other pressing, call it like needs for that capital. Also, when it comes to Cubeler, there are a couple of things that delayed Cubeler. Yes, there's the decision for with regards to the SEC, the process of the SEC, and the fact that we weren't able to confidently commit all of the cash that we wanted to commit to Cubeler. But there's also the fact that when you're looking at Cubeler, the application itself, the Canadian hub, let's call it that. That Canadian hub, one of the things that is going to make it powerful is linking it to the Chinese hub, right? But when it comes to China, the way the hub works right now is not the way it's going to work in Canada and other parts of the world, okay? So people in China right now cannot post messages and do all of these different things. The hub in China is not working right now as a social network, kind of like LinkedIn or Facebook, because there are different rules when it comes to the internet for China than there is for Canada. So one of the things that we're doing with the hub, with the Canadian hub, is what you're going to see is you're going to see an application that resembles something like LinkedIn or Facebook, where there's going to be a lot of emphasis put on the networking capabilities that we're going to be providing to the SMEs. It's not the case right now in China, but we want to bring some of those elements to the Chinese hub because they're going to be linked. The Canadian hub, the Chinese hub, and all of the other hubs that we're going to create are all going to be linked together, right? So we needed to think about that approach for China. So that decision, okay, involves time, it involves capital, which again contributed to the delays that we had. We had the delays, but for good reason, okay? So I hope people understand now why that was delayed. Now, let's go back to this impairment situation, right? So when we made the acquisition of Cubeler, Cubeler was acquired based on, okay, we mandated a couple of third-party firms to do an evaluation of Cubeler, to do a fairness opinion on the transaction before we concluded the transaction. There are three main components when it comes to the value of Cubeler. You have the technology itself, right? The software, the license that powers our applications in China. You have the license, right? Because we licensed, we have a license for Cubeler, right? So Cubeler, the private company, licensed its technology to Tenet, and Tenet operates it, right? So you have the technology itself, but you have the license. The license had value. And the most valuable part of that whole thing is the projected cash flows coming from Cubeler itself, right? So when the acquisition was being negotiated done, Cubeler presented forecasts for revenue for the next X number of years, right? So those revenues, if they are not met, right? This is an accounting treatment strictly, right? So the price that was paid for Cubeler was based on the promise of certain revenue streams to come over the next 2 to 3 years, and then you have a terminal value and so on and so forth, right? So when those numbers, okay, when the auditors learn, well, we had to tell them, oh, listen, we're delaying the launch of Cubeler, which means that the forecasted revenues for 2021 and 2022 are shifted by almost a year, as we mentioned in the MD&A. Well, that shift basically has an impact on the value of Cubeler for Tenet, right? So whereas Tenet paid, let's say 100, using round numbers, so Tenet paid $100 million for Cubeler. I mentioned the license, I mentioned the technology, and then the rest is goodwill, what's called goodwill, but that's based on cash flow, revenue forecast, right? So if the revenue forecast change, it impacts the value that should have been paid for Cubeler, right? So now the auditors are saying that, okay, you know what? The amount that you paid for Cubeler, because these future cash flows are now delayed, then you can't, well, it's not that you overpaid, but in a way it's like, okay, you overpaid because you're not expecting these cash flows right now. Instead of getting them next year, you're going to get them 2 years from now. So there's an impact, right? So this is where the impairment comes in. But it's not like we're going to lose those revenue streams. In fact, when we did the valuation of Cubeler, and my CFO is on the line, he can attest to this, right? So Cubeler presented revenue forecasts only for 2 markets, for Canada and for the US. The revenue streams coming from Cubeler for, call it, I don't know, France, Germany, the UK, South American countries, whatever. Cubeler has a concept with these business hubs that we plan on replicating all over the world. This is not an application that we're going to operate for Canada and for the US, and then we're just going to stop, right? So we're going to be deploying hubs, at least that's the plan. We're going to be deploying hubs all over the world. And the revenue streams that will come from the hub in the UK and France and Germany and Brazil and I don't know, like the Middle East, those revenue streams never factored into the valuation of Cubeler, right? So the impairment hit that we took this year for us, as far as the management is concerned, okay, you know what? It's an impairment. We took a hit. It's an expense on our books, but we're not too concerned about that because we know the application Cubeler, the company that we acquired, will make up for those revenue for that was missed, that was shifted over the next couple of years. And on top of that, we're going to be generating revenue in other parts of the world anyway. So for those reasons, we're very confident about the acquisition of Cubeler, and we're very excited about Cubeler because this is going to deliver a lot more value for our shareholders than what we actually paid for the asset. So again, I don't know how much time that took, Mark, but I felt this is something that, you know, our shareholders needed to know about what went on with the Cubeler acquisition and the impairment hit that we took this year.
No, that was great, and I think well worth the time allocated to it. To kind of follow up on that, and to stick with the theme of sort of outlook and guidance, you know, there's a lot of murkiness in terms of what's going on in the world, in particular COVID-related lockdowns in China. Can you or Golden perhaps comment on the extent to which you see that impacting 2022 revenue, given that Tenet's projected for the China revenue to be the biggest portion of it until the Cubeler starts ramping up in North America?
Sure. I'll start and I'll turn it over to Golden. We haven't decided, we haven't changed our forecast for good reason. We expect that other revenue streams will make up for the fact that Cubeler was delayed. But to the question about like the lockdown in China affecting our business, I'll turn that over to Golden and then also have him speak a little bit about some of the other revenue streams that we anticipate will come in out of China. Golden?
Yeah, okay.
Golden, can you hear?
Okay, can everybody hear me? Yeah. Okay, so yeah, hi everyone. So this is Golden. My Chinese is Liang Chu, and it's first time on this call. I'm a little bit nervous. Okay, so anyway, so I just want to continue the Johnson's answer. So yes, Shanghai being locked down, Pacific thing. Okay, like this, China has a zero policy on the COVID. So if a city has X number of cases, they lock down the city and until back to zero. Okay, and so before this end of March, April, the whole China, the operation like back to normal. Okay, like the whole economy bounced from the past COVID impact, and business actually they do extra work, and our Chinese team actually work until like 1 o'clock, 2 o'clock in the morning, try to catch up the businesses. So this is like what I want to call like Asian tradition, okay? So that so if we miss off some time and delay on some of the homework, we're gonna do our best try to catch it up. This is a kind of our culture in Asian operation as well. And also on the other side is while we're doing this Shanghai lock-in scenario here is Shanghai we have a lot of clients. Let's see, they have warehouses, operations in Shanghai, and the particular lockdown really only affecting those people. And we have other business that after 1 year transition in the Chinese or Asian operation, I would say, that we do a lot of like other areas of business that is booming. And as Johnson just said, the insurance technology, the clean energy, the clean tech, okay, is all picking up. So all this other business is going to make up, I believe, okay, our Chinese team still believes that all this other businesses will make up all the loss that we lose during the lockdown. So we're very comfortable, okay, I would say like let's make the projection intact, okay, and so let's see the what's going on the next. So this is really the answer. So I will see right now, yes, there's some affection on business, but there's also other side of business that could potentially cover up the loss we had. So this is my answer to that.
It's great. Thanks, Golden. Next question, kind of diving into more on the results. So I don't know if this is G or Johnson, but there's an increase in cost of services, specifically for supply chain revenue, apparently for the fourth quarter, whereas it looks like it decreased in Q3 as Golden River came online. Can you clarify like what might have been causing the increase for cost there, and what to expect on that front going forward in terms of margin?
I think the margins actually improved. The supply improved in 2021. Jean, do you right? I think it's just a proportion of revenue that came from the supply chain that changed. Jean, can you answer that?
Yeah, exactly. So the proportion of the revenue coming from the supply chain is higher in 2021 than 2020. So, but that's why you see the cost is higher in dollar, but in percentage, it's lower, the cost of service versus the revenue of the supply chain. If you have only the line supply chain, like I have. So
is that the case for Q3 versus Q4 last year too? That's what this question was about. Was fourth quarter? It looked like it increased.
Yeah. Mm-hmm. Mm-hmm.
Okay. No. The margins actually. I'm sorry. Just to continue on what Jean was saying, the margins keep improving on the supply chain. Okay, so even though, like, I mean, if you look at the number, in terms of cost of sale, right, it looks greater than the actual percentage of the total revenue that was generated for the quarter and for the year. But in fact, it's only like, I mean, the number itself may be greater, but it's because the supply chain business relative to the overall business increase in the fourth quarter and in 2021 as opposed to 2022. That's why it appears like the margins are not improving, but in fact, they're continuing to improve.
Yeah.
Okay. And then to follow up on the supply chain revenue, when do you guys expect to see more of an impact from other verticals in 2022? If you can comment on that.
As Golden mentioned, insurance is doing really, really well. The oil and gas sector is doing really well. These are all sectors that we expect 20 plus profit margin as opposed to just the consumer goods supply chain, right? So insurance, we mentioned that the revenue had shifted by a couple of quarters. Oil and gas was already picking up as of the fourth quarter. So those two sectors plus the clean tech should really be prevalent in 2022 for the company. Again, we're talking about the Chinese operations here, right?
Yeah.
Yep.
Okay.
Okay.
We're expecting an improvement in the margin in total between 2023 and 2021. It was in 2021 and 2023. We have an increase, and we see it. The margin increased by 4.7%, and it's going to continue as per what we forecast for 2022, especially in AGP, in the petroleum and clean tech is not there, but especially in the petroleum business and the insurance business, the heartbeat business.
Okay, that's helpful. Yeah, sounds good. Let's turn a look at the North American or the Canadian side and just talk about delays in launching that, or just in general, how you see that ramping up over the course of this year and into next year. What's that look like?
Okay. We don't have a definite timetable for the Canadian launch yet, but again, I think we mentioned in the MD&A that the approach that we're taking is we want to make adjustments to the Canadian hub in such a way that once we do launch the Canadian hub, we're going to be able to very quickly launch hubs in other parts of the world. Like we have our sites set on the U.S. market already. In fact, one of the things that we want to accomplish is we want to have a subsidiary in the U.S. before the end of this year. So definitely, we're going to launch in Canada this year, begin our operations in Canada, and launch very rapidly, probably at some point in 2023 in the U.S., followed by European markets. Again, the idea is to link those hubs together and build this global network. Again, kind of like, I don't know if I should compare our network to LinkedIn, but it's going to provide small business clients, essentially small business owners, the ability basically to network and not just sell locally, but we want to encourage them to develop partnerships, relationships with other small business owners. And we're going to be there to support them, working with business associations, governments. What we really want to do is really change the way small businesses do business. We believe we have the tools to help them do that through the power of analytics, artificial intelligence, all of this data that we're going to be accumulating throughout their platforms all over the world. We expect to be working with governments to facilitate the cooperation between these small business associations all over the world. So that's the vision that we have, and looking at 2022, we believe that before the end of this year, that will become apparent into everything that we do. Even the Tenet website itself will reflect that, and our shareholders, I believe, will have a much better picture of what we're trying to build here. This is not just a Chinese platform that basically provides services to the supply chain in China. We're looking to build a global network for small businesses powered by artificial intelligence and analytics, basically to impact the way small businesses do business all over the world.
Awesome. Okay. Next one, probably either Johnson or Golden. Got asked about any update on the relationship with ShopX? If you can comment.
The relationship with
Yeah.
the relationship with ShopEX. Golden, this is something more for you, but I believe again, this has more to do with financial decisions that we've made, because that relationship requires substantial investment into business development, marketing, and so on and so forth. Golden, you want to say a little bit more about that?
Okay. Yes. Yes. So right now, okay, the company we had in Asia is called Asian Synergy. Okay, so it's not a Chinese operation, you can say. Okay, because China is the center of the production in the world. So we actually the reason we build up or start our business in China is because we believe that's a lot of like resource in terms of production, sales, everything. Okay, that China is an easier market for us to start with. Okay, so ShopEX which is our partner for like 2 years. Okay, they have over 1 million plus like users that they're e-shoppers, they're e-commerce companies that using their software. Okay, we actually has a partnership agreement with them that we actually gonna offer services, everything to them. But on the other side, okay, we believe to serve the small guys, okay, need substantial amount of marketing, education, training, customer support. If you just offer them like pure service as they already using, for example, you introduce them cheaper funding, cheaper sourcing of the product, whatever, this type of thing, okay? So those are very expensive startup service cost. So that's why it's kind of the decision we made. Okay, we want to start with big channels, start with some large like factories. Okay, first to accumulate our channel like position. So we actually become big and attractive for businesses in China, also in the world. So small SME is gonna come to us instead of we go to them. Okay, and so this is the way we start our approach using the budget that we have. Okay, and due to the delay on the financing and everything. So, but once we start the North American operation, okay, for example, if we start with some major shopping platforms in North American, those SMEs, ShopEX, will naturally merge into a global hub, instead of just Chinese hub. So this is so I will see the ShopEX, okay, is still going, and we kind of right now, according to what we have, we're adjusting the way approaching to get them on the platform. This is really the situation here.
Okay, thanks, Golden. Next question, probably for Jean. Excluding the one-time charges and cost of service, spending was about 14.3 million for 2021. Where do you see that in 2022?
I don't know if it's for Jean to answer, but I can answer that. I see that going very, very high, to be honest with you. Okay, we're talking for those on the call who are expecting us to build a multi-billion-dollar company, having spent like $30. I'm sorry, it's not going to happen, right? So we're looking. Listen, if we're going to take over the world, ladies and gentlemen, we're going to have to spend some money to do it. Okay, so where do we see that going? Hundreds of millions of dollars that we're planning on spending. Perhaps not next year, but over the next couple of years. This is what I want our shareholders and investors to keep in mind here. Okay, we are not looking to remain a $500 million company, $200 million company. This is not why we're here. We are looking to take our place into the global scale of IT, well, not IT companies, but like artificial intelligence companies. We're talking about affecting the way small businesses around the world do business, right? So you have to be prepared to see us spend a lot of money to do that. But again, If you're an investor, you want us to spend money, because if we're spending money, we're building value for you. We're creating value for the company, increasing the company's market cap, right? That's what your focus should be on, right? Just continue to watch us build the business and increase the company's market cap, but it's going to take money for us to do that. So to answer that question, we don't have a number yet. Expect us to spend a lot of money because, again, we're forecasting $300 million in revenue this year, right? So we're not promising 90% margins this year, right? So if we're going to be generating 300 million in revenue, expect us to spend some money.
Fair enough. I think that was a great macro level answer there. So that's really most of the key heart of the questions. So with that, Johnson, I'll conclude the question and answer session and turn it back to you and Golden for any closing remarks you guys want to leave shareholders with.
Sure. One thing. Thank you so much, Mark. Appreciate all of the questions here. One thing I do want to touch on is our capital market strategy, because that's going to be very important for the company going forward, right? So we talked about our vision, our ambitions, and everything else. People need to realize we need financial partners to be able to do that, right? So, and we need to be listed. I love the Canadian Securities Exchange. Great bunch of guys, love them to death. But we need to get into more senior, high-profile exchanges, right? So we talked about the NASDAQ. The plan is still to eventually get back on the NASDAQ. Senior exchanges in Canada, without naming any names. We're still planning on trying to get that done, hopefully sooner rather than later, second or third quarter. That's the timeline for that to happen. And we're also looking at London, right? So not only, regardless of what happens with the NASDAQ or however long that takes, we need to position ourselves basically to be on other exchanges around the world to give ourselves an opportunity to access the capital that we need in order to execute our vision. So that's also part of our plan, and it's something that I want to make sure that our investors keep in the back of their minds here. With that, if there's anything else, any other questions? If there's no other questions, I'd like to thank everybody for their time. I know we ran probably a little bit longer than what was expected for the call. I'm hoping that we were able to address some of your concerns and answer some of your questions about the financials. And going forward, again, global expansion. That's where we're headed. So once again, thank you very much. And we look forward to doing this with you again. Probably next, John, when are Q1s due? Like less than a month.
End of the month, at the end of the month.
So at the end of the month, listen, if you haven't had an opportunity to, if we didn't answer all your questions, please don't give up. Submit, hit up Mark or Kathy with questions. We're going to be back at this in less than a month after we file the Q1 results. So once again, thank you very much for your time. And I look forward to seeing you again very soon. Thank you.